Greetings everybody, this is Jeff Scott and welcome to this week's video. I will only be doing it intermittently over the next couple of months as my day job's gotten busy and the market's gotten kind of unpredictable to the point where things are about as good until the next tweet, which isn't a market that I find is consistent with a lot of trading. So I've been trading less, raised cash, and not really sitting on the sidelines as much as just not being as active as I normally am. As you can see, the title is Weakness Near All-Time Highs, and today is September 29th. As always, this is for education purposes only. I'm a doctor, not a broker. I'm independent. I pay for all the tools that I use, and trading involves risk, and you alone are solely responsible for any investment decisions you make. Whenever I do live education, I always call it the Be Your Own Guru program. I've learned from a lot of smart people, many of which are up here. Really started with Cancelim, improved by Woodward and Brown, and you've heard most of the other names before. My buddy George Lee, Morales and Catcher, John Person, Van Tharp, and Cigar with Superior Profit. I have my own style. It's not necessarily their style, but it's a style that I came together after listening to a lot of smart people and figure out what works for me. Here's the website for HGSI, highgrowthstock.com. I'm independent. My only relationship is if you hit investing strategies, you'll see many videos by me, all free, and then a free 30-day trial. Stock patterns are cyclical. Have we started this stage 4, this pullback? Certainly feels that way, but the question is, for how long? Are we going to zip right back up as we have with most other pullbacks? Clearly, growth stocks have corrected more. I'll show you some more data about that. But when you look at where they are compared to the all-time highs for the major indices, we're not down that far. So we could fall quite a bit more, or we have that bounce up. And I think those are two very reasonable possibilities. So whenever I get an indecision or that uncertainty, it's raise cash, take smaller positions, sell some premium. I still have a few positions that I got burned on, a couple Chinese calls that I had on Friday, but I keep reducing the amount I've got in the markets as I try and sort things out. Major markets tell a story. Here is the future markets. I like looking at them because they capture what happens overnight. Some people might prefer the other way. You could see that on the E-minis we are up a lot since the beginning of the year. We've had a couple of pullbacks during the year, April, end of year 18, and then this year we had April, and we're in the midst of a summer pullback here. Now, if you look at it on this year, the highest highs, and this is a daily chart, I believe. Nope, this is weekly. Hold on a second. Not ready for the weekly, so let me go to the daily. But you can see how close on the weekly charts the all-time highs are. So we're not that far away. So on the daily charts, you can see we hit a high on this going back to October, back here in sometime around the end of July. That was at 30.29. We closed at 29.72, so we're about 100 points off our highs. Now, in many ways, to me, this market's felt weak, but there's been such ferocious rotation out of growth into value that I think the markets are much weaker than the indexes suggest. The NASDAQ futures, the same thing. All-time high back in July, off about 125 points, and you could see drop below at 17 and 50-day moving averages right here, but much closer to a high than a low. The Dow futures, their peak was back earlier in July. Almost got back up to that level in early September, have sold off in between the 17 and the 50. The Russell's been the weakest, although when you look at it, stepping back since October, it's really gone nowhere. It had a deep pullback in December, it came back up, and now it's just going sideways, pulling back down to the 200. The VIX has popped up a little bit, but it's elevated, it's above the moving averages, so that might be concerning, but off its highs. Seems to be trending up right here. And the dollar, its high was 99.37. It got close to that here on Wednesday, and it's near the high of the last year or so. And we know what that'll mean for the metal. So the market has pulled back some, and if I look at weekly charts, let's just go back into the PowerPoint perhaps for that. If I look at weekly charts, you could see we are in dominant uptrends in the three major indexes on the top, the E-minis, the NASDAQ, and the YMs. A pullback from the highs, even better seen perhaps on the weekly on the IWM, kind of in the chop land on the VIX, and the dollars had a huge run up really for the last 2 years. Underneath, there's certain things I look up every week. The rates fell, which is hard to see here, but they pulled back on both the 10-year and the 30. But if you look at the 2-10 yield curve, it's hard to see here. It actually bounced up a little bit this week. So that's good if you're worried about a recession. The AD lines on both small stocks and large stocks turned down. And you can see on the NYSE a little hook down in the AD line. And notice that this is coming off of all-time highs. All the major index ETFs turned down. The only thing that's trending up this week, and no surprise with rates falling, is the TLT, the bonds. Now, breadth eased compared to last week, a little pullback below the stocks above the 200, stocks above the 50, but they're far from oversold and much closer to their high than their low. And when you look at the 3-week new high-low, which is a very quick overbought, oversold indicator, you're in the middle. So certainly no signals here. The daily McClellan, I guess, continues to play out its bearish divergence that we had here. I guess we'll soon be able to connect this line up here, and this is a lower peak here and a lower peak here. So I can redo some of those, but I think the message is true. We're not seeing a whole lot of support from either the daily or the weekly. The current buckets, you couldn't say this any better. This is a market that's mixed. And if you look at the S&P 1500, half the stocks are above the midline, half are below. And when you look at the distribution in the buckets, this is a market that is not giving an overbought or oversold signal. There's no evidence of a Hindenburg since prior to this pullback beginning in August. The market tone flipped from bullish to a couple of bearish popping up, especially in the NASDAQ and the Russell. Sector strength weakened. A number of sectors turned red this week. Now, here's some other things that I might find bothersome if I was very long right now. The Canaries are breaking down. So they've flirted with breaking down for quite some time. You had a Phoenix on the market on Tuesday, I believe, and the market is sold off. Failed to break above the 50, so the Canaries are breaking down. This was the leaders from early in the year, and I put this together back on March 3rd. It ran up a little bit, and the whole point of a leaders index is when the markets are done and they're rolling over, typically the leaders break first. And it's been interesting, despite the market changes, the leaders index has not broken until now. And in fact, it's pulling down right above the 200-day moving average. If you think you can manage your growth stocks in this market and make money trading the way you traded 3 months ago, you're wrong. This is the IBD 50, I don't know why, not really 50K, but the IBD 50 managed ETF. And look as it's breaking down. And what's interesting is it's down 11.1% in the last 49 days. Now, that's what this market feels like to me, a market that's corrected 11.1%, but this is growth, and they've clearly corrected more than the major indexes. Know your news and earnings. I think Friday is going to be interesting. You have employment reports Friday morning, international trade, but 2 o'clock you got Jerome Powell speaking while the market's still open. I think the market's going to be a little bit on edge about how many more rate cuts we're going to see. There are some energy reports on Wednesday, manufacturing on Tuesday. Got a couple other Fed heads speaking during the week. In fact, you got some even speaking on Sunday. So it'll be interesting to hear what we hear from the Fed heads. But whenever you have a monthly employment report, it's a big news week. Not much on earnings, of course, if you own things like Costco, Pepsi, Bed Bath & Beyond, Lennar. It's a big week for you. And it's a judgment call to hold stocks over earnings. It's bad judgment to not know when your stock's earnings date is scheduled. So what are my thoughts? Trade war fears led markets to limp into the weekend. From a seasonality standpoint, some believe you sell in Rosh Hashanah. My spelling is bad. I apologize. And buying Yom Kippur for those that are not Jewish. Rosh Hashanah started tonight. To my Jewish friends out there, Happy New Year, Shana Tovat. We have about 10 days till Yom Kippur for those that are wondering when the second holiday is. Micron weakness after earnings pulled down the semis. News flow likely to continue to drive markets. Trump's threats to delist China. Pelosi's impeachment talks. Powell on Friday, as I mentioned, and we're still going to get some zingers from Brexit. So many portfolios are underperforming markets, which are still up double digits on the year. Recent trades, especially hard on growth stock investors, as rotation into oversold and value has occurred. I expect we eventually see some bounce in some of the oversold stocks, but there's still not the time to be a hero in this market. So let's take a look at my typical top-down. I don't think this is going to be a particularly long program today. All right. Now, in TradeStation, those who've been following me know that I've got about 5 or 6 things I like to look for on the major indexes. Yes, the futures are up today, right now, but in 12 hours, they could be down 100 points the way the market's gone. So if we look at the NASDAQ futures, and actually I like looking the other picture better. Let's look at this one. Okay. Let's start with the E-mini. There's about 6 things I'm looking for here. First, I'm looking at the arrows. These are John Person buy and sell signals. We got a daily sell, weekly buy, monthly buy. So in a longer term uptrend, we've got a short term sell signal. I look at the elder indicator of the impulse indicator, which is the color of the price bar. In green price bars, you could be long or holding. In red price bars, you should be short or holding. In blue, you can do whatever you want. We got red on the daily and blue on the weekly and green on the monthly. So that's bothersome. Then I look for these little red dots. When I see the red dots above, I know the market's overbought and is likely going to pull back, but it could take time. When I see them below, they're oversold. I look for where we are in the envelope. We're in the center. I look for the weekly bongo, which hasn't changed yet. And then I look at how far my high jump is, but we're not extended. So I see here a market that's weak, and I don't see any obvious reason why it changes anytime soon, although the new way this news flow is, it could happen tomorrow. Dow futures look very much the same. NASDAQ futures, the same. Russell's a little different in that it's not in a long-term buy. The monthly is in a sell. It's got red on the daily, red on the weekly. Probably the most beaten up of the major indexes. The dollar, the strength, but you can see these red dots coming in here on both the daily and the weekly, yet it's still in a buy signal with green. And I thought I put the VIX in here. Let's see if I got it here somewhere. If I look at the VIX, this is a cash. You can see it's green and heading up, although longer term it's down. So on TradeStation, I see markets that are under pressure. All right, let's take a look at HGSI. And I like going into the market analysis group, Major Markets Plus. Pop that up over here. And let's just go the top-down view. So this is ranking stocks, make sure by the last 3 days, the last 1 day, the last 5 days, and the last 3 weeks. And you can see strength in the dollar, utilities, volatilities, and treasuries. Now that should tell you something. That should tell you that this is a weak market. And then in the stocks, big stocks, trumping the NASDAQ, biotech, mid-caps, and Russells. So those of us that are high-growth stock investors, this was a difficult week from an index perspective. So let's just pop through some of these very quickly. sorry about that, wrong one. All right, perfect. All right, so we'll start here with the S&P 500, and I just want to point out a couple of things. We are at a point that I think is important support. If I bring over my drawing tool here, clip into this, I don't want it to be boxes. Hold on a second. This, to me, has been an area of support, resistance, and we've oscillated around it, and we've pulled in, touched it now 4 days in a row. It's kind of right on top of the 50-day moving average. I think we're in a very important part of this market. We've pulled back. Wouldn't surprise me to bounce from here, but a break below here, you got to think this 200-day moving average is in play. It's only about 140 points below where we are today, so certainly not a draconian drop. In fact, I made the comment that it feels a lot worse than it probably is. If I just look at, frankly, from recent high down to where we closed at, we're only off about 3% in the last 5 days. So the markets are probably not nearly as bad as they feel because I have mostly a growth stock interest, but I just think we're at a pretty critical point on the S&P. If I look, and there's a low close doji on the weekly, that can never be good. If I look at the Dow, again, above the 50, which is probably an important place. Now, this has been an important line in the sand, and we've closed behind it, although I'm not sure it's meaningful right here. Again, notice this Phoenix, which occurred, this will be on the major indexes, which occurred on Tuesday. A Phoenix is sort of a follow-through day to the downside and usually predicts further weakness, especially at the beginning of a move. The NASDAQ composite breaking down below the 50. Low close doji over there, new sell weekly signal. And then the Russell 2000 struggling to stay above the 200. It's hard for me to look at those and be bullish. A day can make a difference, but I have a hard time committing all my cash to the market, and hence why I've raised cash, have less positions, etc. If I look at the dollar, near all-time highs. I look at the VIX, kind of in chop land, although it's popped above the moving averages. Break above this line here would be bothersome. And then lastly, if I want to look at gold and silver, you can expect they were weak with the dollar strong. Pull back to a support. Now, if the market was sitting like that, I'd be looking for a bounce. And silver, also sitting on support. So those look more likely to bounce than perhaps the major indexes. So I start my top-down review, just as I've done, and I look at some of the internals. Trade stations running all day long. I've now looked at HGSI. My sense for the markets is weakness. I'm probably not looking to buy a lot or buy anything necessarily. I might be interested in shorting, but I'm going to let the markets dictate by how they open up. I'll look at the industry groups and see if there's any pockets of strength. You can see I've got 176 groups, and I do the 2-day up. You can see I've only got 16 to the upside over 2 days, 17 over 5 days, only 16 down over 2 days, which is interesting. Private equity, payment, REITs, IT, computers, home builders, autos, refiners, real estate. Some of these are typical growth stock names, but here's where all the stocks are hiding. 72 industry groups, 1 minus the industry index, are down over a longer term. That's why the weakness in the market. Semiconductors, apps, biotech, internet, specialty pharma, internet-based. That's why a growth stock portfolio is probably not very happy. So what I like to do is I like to look at some of the top groups. Again, there's not many, so let's just look at diversified banks and see if any look interesting. Now, Wells Fargo looks interesting. It looks interesting. It broke out on the weekly here. It had a buyable gap up on Friday with a new buy signal and a kahuna. Everything's green up here. It's been falling for quite some time. Let's change it back to my regular view without the Bollinger Bands. Don't want those. And the difference, why I'm interested, so I got kahunas, pocket pivots, my indicator fired, mobile breakout, everything's green, and a buyable gap up. They hired their new CEO. Obviously, the markets thought highly of it, and it rallied. So that's a good sign. I'll be watching Wells Fargo. I have a position in Bank of America. I bought it at the end of the 07-08 turmoil in the single digits. It lives in the mid-20s, and it's in the mid-20s here, middle of its range. You know, it's hard for me to understand with falling and such low rates where banks are going to get their energy from. But Bank of America is a core holding of mine, and I do occasionally buy puts. They're pretty cheap on it. Right now I'm just sitting on the stock. 2% dividend, not great. Citigroup looks similar. JP Morgan, right off of its all-time highs, a couple of doji days in a row, 2.7% dividend. I think these stocks, this group is up on top mostly because of Wells Fargo. Entertainment content, not a group that I know much about, being that I'm in healthcare, but what I see are stocks that have been beaten up that may be bouncing, and that's kind of what's, so I get this fixed. Hold on a second. It's kind of what's driving them. You could see that you've got double bottoms occurring here, even with a breakthrough below, and then you had a big up move, or a relatively big up move on Friday. You know, in a really bad week, any kind of a positive move or in a bad market will bring that group up to the top. It does have earnings per share growth, doesn't pay a dividend, low multiple stock. That's Discovery Communications. Here is their other, I don't know the breakout of these two stocks, multiple of 8, no dividend, and that the rest you get to the index, so I don't go further. Department stores, it's kind of hard to believe. But again, things that are bouncing off the bottom. Here's Dillard's. I wouldn't buy this here. There's a lot of resistance just above it. Have to break through that for my taste. And Nordstrom's, similar story. These are stocks that were up a little bit last week in the setting of a bad week. Yes, I'm not finding much to buy. I apologize for that, but that's the market that we're in. Kimberly-Clark, you know, this is where the strength is. Here is a stock that pays nearly a 3% dividend. It's probably at the higher range of its PE multiple. It does not have a lot of growth, but this is the kind of stock people buy when they think the market's in trouble. I don't believe we have a bear market anywhere close. I think the market will ultimately go higher. But obviously some people disagree, as you're seeing accumulation in stocks like this, which are consumer products and historically are defensive plays. Procter & Gamble, similar story, beautiful lower left, upper right tight pattern. Spectrum Brands, not as pretty a chart, but a big move on Friday. Not the kind of stuff I like to buy. Home improvement. Talk about consumer staples, or in this case, discretionary. Defensive stocks. Whirlpool, houses are up. You're going to have to buy refrigerators, washing machines, and dryers. So breaking out here, weekly looks pretty good. Again, not my kind of stock. Reducing earnings per share growth. Pays a good dividend, multiple of 10. Masco, they own a lot of your cabinetry and other brands. You know, you got an uptrend, you pull back to support, and you're moving up. Sure, earnings per share growth tepid, 1.2% dividend yield. Not great growth. Mohawk, flooring and carpeting, down in the pattern. iRobot. You know, I look at these, I just don't see something that I want to run out and go spend my money on. Apparel footwear, well, Nike had some good numbers, and Nike's leading this group higher. Again, I guess shoes are pretty defensive. Breaking out to new highs here on Nike. Bible gap up on Wednesday, continues to go higher. It's got next earnings not great, but the following quarter earnings are picking up, pays a small dividend. Deckers, bounce. Again, where is the growth? Where is the growth? I'm not seeing anything I like. Skechers, maybe following in Nike's footsteps. At least it's got earnings per share growth greater than the multiple. It's under demand. That one looks interesting. Back. Large pharma, these pay dividends. I'm a little nervous by large pharma in the setting of healthcare reform and the fact that Elizabeth Warren is the leading Democratic candidate. But AbbVie pays a huge dividend, is moving up off the bottom. It's trading at a multiple that's low for it historically. I personally own AbbVie stock. Pfizer, 3.9% dividend. You know, in a downtrend, probably less attractive to me, as is BMS, although it did have an uptrend and pull back a new buy signal. They've got a big acquisition at Celgene, which they'll be digesting soon. Novartis, not as nice. And then GSK, this is an ADR, so it's kind of gappy at the high of its pattern. Of this group, I like AbbVie. As I said, I have a position in it. Airlines, fuel oil prices are down. Maybe that's good for these. Notice those are all international airlines on top. Delta announced a 20% or 25% purchase of LATAM this week, on Friday, and you can see a Bible gap up there. Copa is another South American airline, had a positive day. Ryanair, a discount airline. Azul, another South American airline. You know, there's no American airline made the list except for Allegiant, and I'm not traveling on Allegiant. I'm probably not going to buy their stock either. Basic diversified chemicals. Lyondell-based industries. You know, it's above its moving averages. Like to see it cross the PSAR. It's got earnings per shares coming in, pays a 4.6% dividend. Eastman Chemical, below its 200, Poly 1, not yet. Celanese looks interesting, a run up, pull back, so you got a bull flag here. Let's see, fundamentally, not much. It's got some earnings per share growth, pays a 1.9, probably like LYB better. Yep, of the group, I like LYB the best. And then lastly, integrated oils. These are way down. Many of them pay dividends. And I'm not sure they count as mattress stuffers anymore. ExxonMobil, down in its pattern, 4.7% dividend. Royal Dutch Shell, 6.1%. 5.6. Total 4.6. Notice it failed at 200. YPF sort of living on down in the bottoms, a bottom fish, 2.3. Again, not great looking chart patterns. You're buying these because of potential opportunities on the dividend and a recovery in oil when some of these current China and other messes go away. I did find some stocks that looked interesting to buy. I'm going to look through them very quickly, and then I'm going to look at some of my shorts, and then I'm going to say goodbye. So I'm going to pull up my buy list, and these are not necessarily great things, and I'll talk about each one individually. I found 20 stocks that I might be interested in, at least watching this week. So very quickly, Wells Fargo's we already talked about. Here's Marathon Petroleum, 3.3% dividend. A refiner broke above its 200, new uptrend. Looks interesting here. Ulta Beauty got clobbered, had a weekly high close doji down here. It's kind of a bottom fishing buy. I treat these different than growth stocks. I don't take a lot of risk on them, but perhaps if it clears its chandelier exit, I might be willing to start nibbling on Ulta Beauty. Nike we already looked at. AbbVie we looked at. Urban Outfitters. Here's a retail stock that is now in an uptrend since the middle of August. It's right under resistance. I'd probably wait for it to clear this 200 and maybe retest, but Urban I'll be watching. Notice how much demand versus supply. Here we just looked at LYB, we looked at Shell. For whatever reasons, and you don't usually see this in a recession, the packaging companies several of them were breaking out. So here's GPK. This is breaking out here, pull back, and now breaking out with a kahuna. Mobile breakout from a squeeze. It's above the magic line, pays a small dividend. Weight Watchers, it's one of these bottom fishers that broke out, ran around the 200 and broke out from there. Even on Friday, it was up 5%. Realgy Holdings, this is a bottom fish, but it started to move up, and these are some of the things that have been working for me of late. They're very short-term plays. It makes money, very small multiple, cheap stock, 5% dividend. The Real is an IPO, broke above the 50 here. And I step away. So the Real page has a weekly high close doji. It's an IPO. Some people might wait till it clears the IPO price. Something to look at. There's not a lot of good things. Amtech, sideways move, breaking out. Has earnings, small dividend. Francesca's, this is sort of one of those bottom fishing stocks. This is the pattern I've been buying. Break above, nothing forever. Breakout, pull back, and when it makes its next move, I buy it. It's in a bill flag here. That might be interesting. Xylem, flow control. This was the next bullish group if I went down, I think, 11 or 12. But you could see weekly, crossed above the magic line, had a kahuna on Wednesday, broke out here out of a squeeze. At least it looks interesting, 1.2% dividend. Kinder Morgan, sideways in MLP, 4.4%. This is a crappy stock or crappy company. It's been beaten up. It's been up for sale, taken off of sale. Trades at a dividend at a multiple of 2.8, pays a 14% dividend. 14% on a $5 stocks is about 70 cents, and it makes plenty of money, it looks like, to pay that dividend. It's got earnings coming in, although no earnings per share growth. It pays at a very small multiple, and somebody's clearly accumulating it. GameStop. KB Home, that's probably the best looking leader here, a little bit of a flag. Williams-Sonoma, sideways move, looking for a breakout, did have a weekly high close doji. Inferna, this is a technology company, sideways move, a couple of kahunas. Folks, there wasn't a lot of great stocks this weekend. I don't even think we'd say much about that. Those are some that I picked. What do they have in common? Many of them are basing. Some of them have pulled back and look like they're starting to move. These are not a weekend of high growth, great stocks to go look at. I probably shouldn't have even showed them to you. Now, just because I like them, it doesn't mean I buy them. Those who've been here before know I stick them into something like TradeStation, and then I'll be monitoring them for signals to occur during the trading day. On a big monitor, I can see all the way to the right, so things like the John Person indicators, the earnings dates, market catcher, etc., will populate as well. Pull this back On the shorting side, there are easier to find stocks to short than they were to buy long. Now, the interesting thing is usually when that happens, I find the market seems to bounce. So let's take a look very quickly, and then I'll say goodnight.